Hello, everybody. Welcome to the Edge Singapore's REITs Masterclass, Why Invest in REITs. I'm Guda Warden, Executive Editor of The Edge, our Singapore's leading main weekly investment and business publication. And I've been covering REITs since their inception in 2002. I need to show you the disclaimer and to let you know that this presentation is for information only, and we can't give a view on buy or sell or any particular REITs that is listed here. So it's a disclaimer. So thank you very much for signing up. So based on feedback, this presentation is at a basic level. We've divided it into 6 parts. First off, part 1, why invest in REITs rather than stocks or Bitcoin? Then second part, what is a REIT? A third part, what are its characteristics and how does it differ from equities? Choosing a REIT at number 4, well, that's a personal decision, but there is a difference between small cap REITs, which trade at discounts to book and higher yields, and large cap liquid REITs, which usually trade at premium to book and tighter yields. Which one is the right one for you? You've got to decide. Then we have at 5 a touch on expenses and externally managed REITs compared to internally managed REITs. And finally, we take a look how the pandemic has affected demand for different asset classes and hopefully what the future could hold for us. All right, why REITs? Well, we hope to provide you with 3 key reasons to invest in REITs. The first one is, well, it's yield. Buying and selling a building requires time and patience and a lot of capital. It's easier to buy and sell a building through a REIT. So REITs are stable, asset-backed instruments that provide a steady cash flow and yield, unlike the middle diagram, Bitcoin. Now, Bitcoin is very volatile. It is not backed by a building or any particular asset. It's not a store of value. It is nothing like the dollar, the yen, or any other currency. It's a speculative cryptocurrency. So it does not provide, Bitcoin does not provide investors with dividends. Now, look, a REIT does. And this gives the REIT investor the flexibility of reinvesting the dividends in another REIT, in the same REIT, or buying something else, or like some of us, just spending the money. Yeah. Now, REITs have outperformed equities over a long period. Here we have the chart of the REIT index, FTSE REIT index versus the Straits Times index over 5 years. And we've seen that it's outperformed the total returns with dividends reinvested. For the REIT index, you'd be up 57%. With the STI, you're up 34%. So even though REITs provide most of returns through their yield, their total returns are still commendable, and it's still managed to outperform equity. Over a 10-year period, the REITs have outperformed the STI by 3 times. We start here with just coming out of the global financial crisis and into the European debt crisis. And of course, during that period, we had quantitative easing, interest rates were low, and that's positive for REITs. And then when we had a taper tantrum, and when we went to Donald Trump's presidency, all he thought about was the market outperforming. So he leaned on the Fed to keep interest rates low. And there we had a fantastic run. We had a fantastic run for the stock market, but for REITs, it was even more dramatic. And after the pandemic, everything shut down. So all of us fell, but the REITs, if you look at the chart again, recovered faster than the stock market, than our STI. So over the 10-year period, over 10 years, 2010 to 2020, we've had the FTSE REIT index returning you 131% in terms of total returns, and the STI just, well, short of 44%. So if that's not convinced you, well, I hope it does. So many of the REITs have actually returned you, or would have returned you all your capital in just their distributions per unit alone. Over here, we have this particular REIT. One of us, it's actually Fraser Centrepoint, and it was listed in 2006, and over the last 16 years, 14 years, it's returned you more than its IPO price, which was 88 cents. So in DPU alone, you'd have got all the money back. And of course, it's well above $2, it's $2.40, something like that. So you'd be, that's where your 131% comes from. We put another example here, which is even more dramatic. This is Parkway Life REIT, and I show it because it's over the last 10 years, it's also been one of the best performers. So here we have all the once again, with the DPU alone, you would have had 100%, 118% growth in DPU alone. And IPO price, guess what? $1.28. It's, I think, last traded Friday at $4.60 or something like that. And Parkway Life REIT is unusual in that it has not had a rights issue or raised equity from the market at all in all these years. In fact, up to 2020, from 2007 to 2020, it didn't even have a general mandate. A general mandate is the mandate that you, as unit holders, give the REIT manager to issue units, to buy, to pay themselves, to buy assets. And Parkway Life didn't even have that. So it never had a placement, it never had a rights issue all these years, and yet it's returned you all that. But, and there's always a but, but no investment is without risk. And of course, REITs can lose you money as well. This table shows you that some REITs can lose you money, some REITs can make you some money, and some REITs can make you a lot of money. If you look further down, you'll see some of the REITs have returned you in the last, this is over the last 10 years, including dividends. Some REITs have returned you more than 300%. So the difference between what returns you more and what returns you less, well, there are many factors. Of course, quality of the assets, where the assets are situated. And of course, if the assets are all in Singapore, you know, at one point, I was having a discussion on Monday, at one point, investors liked Singapore-only REITs, REITs with assets all here, because you can easily visit them. You know how they're doing. You know whether their condition is kept, you know whether it's been painted or it's a rundown building or whatever. So the quality of the assets, and then the country's sovereign risk profile, and then the country's risk-free rates. So all these things affect the value of the asset. And then, of course, you have the sponsor and the manager. And I think in the view of a lot of fund managers, the strength of the sponsor is very important, because all managers have to act in the interests of unit holders when there's a conflict between the sponsor and the REIT. But some managers may be pressured to act in the interest of the sponsor. And we've seen this over the years. There could also be problems with size. Now, small REITs have less liquidity than large REITs, and liquidity affects their cost of capital. So small REITs have higher cost of capital, so they trade at higher yields, and large REITs, which have a lower cost of capital, and they trade at more compressed yields. And sometimes small REITs could be held hostage to certain speculative hedge funds who do not have other unit holders' interests in mind. And this has also happened in recent months. Okay, so a future. This is a beautiful, futuristic looking building. And I'm sure some of you who are watching are not Singaporeans, but if you believe in the future of Singapore, the way I do, then you'd also invest in REITs, especially those with Singapore assets, because properties are tied to the future of Singapore. So how do you invest in a REIT? Very simple. They're easy to invest in. Just open an account with your local broker and start investing. Now, in the past 2 years, 3 years, we've had new brokers come in that offer you very low rates. Some of them are, foreign, Saxo, for instance. Yeah. So there's a slight difference. Most people won't notice the difference, but there's a slight difference between the local broker, such as your Poems or your OCBC Securities or Lim & Tan or UOB Kay Hian, Maybank Kim Eng. When you buy through them, the REIT goes straight into your CDP account. That means you can vote, because equity holders have some privileges, and one of them is to be able to vote in AGMs and EGMs. So whereas if you hold if your units are held through a nominee account, there's slight difference in the way the votes go. Okay? I've been told by my director, who's sitting here, and my producer, who's sitting here, not to go into detail about this because I'll confuse everybody, so I won't. But just as a little bit of look back in time, in 2016, in a REIT called Cambridge Industrial Trust, which no longer exists, it's something else now, is a totally different animal now. Unit holders voted against giving the manager a general mandate, so that the manager couldn't issue units to itself, to pay itself. It couldn't make an acquisition. It couldn't grow. Its hands were tied. And I think the following year, when there was a change of sponsor and manager, the unit holders voted for the general mandate again. In 2017, during a contentious EGM, unit holders of Sabana REIT didn't give their manager a general mandate, so the manager couldn't do anything. And once again, we had a change of sponsor and manager. So we've had some exciting times through the years. So what is a REIT? So the best way we thought we would demonstrate this is through a building, a well-known building, a mall, a destination mall. Originally, I have to say this, my producer over here and my director over here wouldn't let me put up the mall that I wanted to, which was Causeway Point, because they told me nobody goes to Causeway Point. But that's not true. We don't go there, but Causeway Point has its own catchment. Now, VivoCity is different. VivoCity is different from Causeway Point. Causeway Point's a suburban mall. VivoCity is what people call a destination mall.
even if you are from the east or the north, or wherever you are from on the island, you are more likely to have visited Vivo City than, if I may say, Causeway Point. Is that true? Yes, they're all laughing at me here. Okay. So it's the largest mall in Singapore. It's situated on an MRT interchange, which is connected by an underground passage to a bus interchange. And there's a food court, there's a hawker center there, cheap food. So it's easily accessible to anyone from anywhere in Singapore. Not only that, I mean, if you fly in from Changi, you can also take, when we can fly in, I mean, at some point, we can take the MRT and go straight here. And in addition, just like Causeway Point, Vivo City has its own catchment population, which is the Telok Blangah area. Yeah? And this also includes private housing, Keppel's waterfront properties, you know, the reflection, the futuristic looking building there, reflection, and the Caribbean, and also the wealthy enclave of Sentosa. So it's got everything. So it has to cater to people from everywhere. It has to cater to the rich, to the middle class, to its own catchment. And so it's got an array of tenants. So we come to what's in Vivo City. So these are some of the tenants in Vivo City. Yeah? You can go there for a meal. I just highlight one place only, Green Common, because I'm not a meal, that's a vegetarian restaurant, cafe. Right? And then there's a supermarket. There are other places, there are food courts. I think there are 2 food courts. Anyway, please go and find out for yourselves. Now, the point is this. Its tenants get revenues from the shoppers, and some of that revenue is used to pay the rent. Okay? So the more shoppers that visit the tenants, the more the tenants collect, and tenants like malls that have lots of shoppers. So popular malls have good occupancy rates. We come to occupancy rates another session, but it's just an indication that the more popular the mall, the better the occupancy rates, the more likely you'll get tenants, and the better your revenue, which goes to the owner of Vivo City, which happens to be Maple Tree Commercial Trust. Yeah. Valuation. Do you know what Vivo City is valued at? More than $3 billion. So obviously we can't afford it. Well, I can't. I mean, I'm sure maybe some of you can, but I can't. So we can't buy the mall, but we can buy the mall through Maple Tree Commercial Trust. So if you are an avid shopper or an avid restaurateur or someone who likes to go around eating and shopping, and you go to Vivo City, one way to get back the dollars you've spent is by owning the REIT, Maple Tree Commercial Trust. And unit holders own Maple Tree Commercial Trust. And you can buy units in Vivo City or the REIT for a few $1,000s. You don't have to pay $3 billion, it's $3,000. A bit of look back in time, you know, from one REIT in 2002, actually the first REIT, Sing Mall Property Trust, didn't take off. So they couldn't get interest to buy the units. And so it was withdrawn, and eventually it came to the market in 2002, and that as capital CMT, and the rest, as they say, is history. Right? So from one REIT in 2002, we're now at 38 REITs. This slide shows you 40 REITs and business trusts. So out of this, there are 2 business trusts. One has been in the news recently, Dasin Retail Trust. So along the way, we've had M&A, we've had the global financial crisis, and then we've had M&A because we realized that there were lots of issues with some of the REITs during the global financial crisis, such as too much debt and the inability to repay that debt. And we've had some privatizations, and we've even had a REIT that has very sadly had its properties sold in the US bankruptcy court supervised sale. So we've had everything virtually. All right. These are the largest REITs. And I've taken this from one of the Maple Tree Commercial Trust presentations. These are the largest REITs listed on the SGX. And I show this because liquidity is an important factor when you're looking to invest in a REIT. So liquidity is important because as a small or large, because you may be large, as a large retail investor, I am a small retail investor. So for retail investors to buy and sell stock, it's easy to buy and sell large liquid REITs. That's one. And selling a REIT can be important when you want to monetize your investment quickly. And institutional investors like liquidity so that they can buy and sell easily. And fund managers also like liquid REITs because they may need to at any time redeem their units. So they can just sell and also to buy. And a lot of them have liquidity metrics, which they look at before they invest in a REIT. So the large REITs, I think I mentioned earlier, have lower yields, cheaper, lower cost of capital, which means that they can grow easier than the smaller REITs, which have higher cost of capital, higher yields, and therefore they have challenges growing. And I think there was a case last year, I think Soilbill, the business REIT, said it wanted to privatize because it had difficulty growing because its yields were too high. Okay, so just one little pointer before we leave this slide. You need to be aware of who your other investors are, such as the sponsor and the major unit holders, and also if there are any hedge funds around, because they are just in it to make a profit and they won't hold it for the long term. So, so the characteristics of a REIT, and some of it we have seen as we've gone through the previous slides. So they're liquid. I mean, certainly more liquid than property, easy to buy and sell. Okay, a bit of a touchy subject, tax, but for REITs, there is no withholding tax on the distributions or the dividends from REITs. I say tax is a touchy subject because we've got a cover story this week on tax, actually, global tax. But anyway, REITs aren't part of that because there's no withholding tax on REITs. They're asset-backed and investors can actually see the properties owned by the REIT, especially if they're here or if they're or even if they're overseas and they're not in faraway, if they're in the center of town. So I'm thinking of really Ascot REIT, residential REIT, a trust, where they have these beautiful properties in the middle of Paris. So investors can see the properties owned by the REITs, and REITs have to pay out most of their distributions, 90%, for tax transparency. So you are almost guaranteed dividends from a REIT, except during the pandemic, where a lot of them had to cut their dividends, but that but the government had to pass an act for them to do that. Yeah. Right, so choosing a REIT, I've said choosing a REIT is a personal decision because the large REITs have lower yields, the small REITs have higher yields, but there are pros and cons for both. But one way to see how well a REIT's properties are doing is to go and look at the properties. So if you're in Singapore, you can visit a shopping mall And you can have a look at the footfall. There are lots of shoppers like this. I think we've just mentioned, we have lots of shoppers. The tenants are happy, and therefore the REIT will get more revenue from more tenants. And so you can see the footfall, the tenant mix. And I think a lot of the retail REITs look at tenant sales and the footfall. So for office buildings, you can actually, well, pre-pandemic, you could actually go and look at the rent roll, the tenant list, pre-pandemic. And industrial buildings are tricky. Okay, so data centers won't let you in, so you can't go in for security reasons. Yeah? And I personally have been asked to leave the premises of an industrial building. This is because at one point, I have to digress, everybody here. Yeah, I have to digress. At one point, a lot of industrial buildings were under master lease. Okay? So that's getting increasingly less under master lease. So in order to see whether the industrial building actually had tenants, because some of them were master leased, to the in a sale and lease back. So people want to get rid of the property, so they sell it into the REIT, and then they pay the REIT the rent. Yeah, and usually it is above market rent so that they could get a high price when selling it into the REIT. So I've gone into industrial buildings to actually have a look at the real occupancy. And when you go into these industrial buildings, which are not, well, they're definitely not like Vivo City. Yeah, they're a bit sad. You can see that, oh, they're not really full. So you can actually do that, but pre-COVID. And when I was looking around one of them, I was told to go. Okay. So metrics, REIT metrics, maybe that's another topic, REIT metrics. So there's some, there are these acronyms in REITs, DPU, which is distribution per unit, price to NAV, price to net asset value, is gearing, and there's net property income. Let's have a little look at them one by one. So distributions come from the revenue and less expenses and so on. And investors should actually look at the sustainability of the distributions, at the tenant strength, at the credit quality of the tenants. So these are factors that support distribution. And the net asset value also depends on the outlook for rents, because valuations in REITs depend on the cash flow. The cash flows are capitalized using a discount rate. So rents are important there. Let's move down to the net property income. The net property income, and we'll look at this in the next slide. The net property income is the rent, the revenue, the rental collection and the revenues, less expenses. And when REITs buy and sell property, they look at the property yield of the property for evaluation. So the net property income leads us to the NPI yield, which is the NPI divided by the capital value of the asset. So there's a relationship between the NPI yield and the REIT's cost of capital. The lower the REIT's cost of capital, which includes debt, of course, to an extent, the easier it is to buy a property. Of course, if your cost of capital is high, your debt cost is high, you're a small REIT, your debt costs are higher and your yields are higher, then it becomes difficult to acquire and to grow. So that's the NPI. The NPI yield relative to the REIT's cost of capital. Gearing in the REITs is the total debt less total debt divided by the assets. And gearing used to be, okay, right in the beginning, rated REITs could gear up to 60%, but they never did. and unrated REITs had to stay at 35%. Then we moved on to a single tier. Everybody was at 45%. Then we had a discussion that, 45% is too low because the private funds can get up to 50 or 60, or even when you buy a house, the mortgage, some of you, young ones, could get mortgages of up to 80% of the value of the property. So the REITs can only pay, the REITs were stuck at 45%, and people felt that was unfair. So that's moved up to now 50%. We'll talk about capital management in another session, but just as an addendum, during the global financial crisis, a number of REITs had to recapitalize. That means ask their unit holders for money because the valuations fell and the gearing went up, and they couldn't refinance their debt because liquidity was very tight at that point. Okay, but of course everybody's a lot more with it now, and everyone's kept their debt at very manageable levels. Okay, so we're going to look a little bit at REITs Financials. Just stay with me for a short while, because I know there are lots of little figures here. So I bring out the expenses because I want to point out that there's a difference. The Singapore REITs are all externally managed. Okay? So there is an extra layer, could be an extra layer of expenses here. Right? So we have the gross revenue. We look behind. Okay, we have the gross revenue, and we have the property operating expenses in the big table. In the table in the front, we have the property expenses divided into different parts. So you'll see there's a property manager's fee, because every building has a property manager to take care of the utilities, the securities, the cleaning and the lights and the air conditioning and so on. So property manager's fee. There's a property tax. There are maintenance expenses. There are other property. So this REIT down there has other property expenses. Okay, so what were these? Now these were provision for doubtful debts. So these are tenants that can't pay. So you've got that. So it was, for this one, it was 861,000 in the first quarter of this year, which was their second quarter versus their second quarter of 2020. And so, which was only 31,000. So the doubtful debts went up a lot because we had the pandemic. Yeah. So for REITs listed on the SGX, I have to go back to the big table behind. For REITs listed on the SGX, there's an additional layer. There's a base fee, and this is given to the manager. Right? And there's a performance fee, but I think for that particular period, this REIT did not have any performance fee. So when you choose a REIT, you may want to look at its financials, which are freely available, just to make sure that the fees are not too high relative to its asset size and its revenue and its NPI. So the final topic is today's REIT market. Okay? So I think for all of us, COVID has changed the way we live and work and meet customers and business associates. And work from home, WFH, has become a way of life. And consultants expect this to have impact on office occupancy. In fact, the actual occupancy of offices now is lower than the 90% that all our office REITs have reported. I bring out something that Paul Krugman, Nobel Prize winning, 2008, I think he won Nobel Prize for some trade thesis he did. So he said this, he says that, the pandemic has produced, different things, it's changed industry. It's forced millions of Americans to work differently. And the obvious case is remote work. So he says that office occupancy rates have gone up a bit. He's talking, I think he said this about a week or two ago, very recent. Yeah. But they're still below a normal. He says many workers will no doubt eventually go back to the office, but it will not be the same as it was pre-pandemic. And this chart perhaps gives you an idea of how unsame it is from pre-pandemic. We've got, I think this is the March, this is an American company. So we've got this chart from March last year to June this year. And the big plunge is when the entire economy shut down. Well, it was a global impact. The pandemic came in, all of us shut down. We had our circuit breaker, they had a lockdown. And there has been some recovery. And all these are New York. You see, America has many, many cities. Singapore, we only have one. We're only one small little island. And there's a CBD, and then there's a decentralized office. There's a grade A, there's a grade B. America has many cities, but all of them are showing, even though some of them are doing better than the others, they're all showing the same trend. They've all come back, but they're way off the high. And this is as of June, end of June, and 23rd of June. And this is when America was getting back to normal. But, as we know, we've had our Vietnamese hostesses case here. So where the number of cases has gone up. So American cases have actually gone up in states where people don't want to vaccinate, you see. So the extent of the recovery here will really depend on the pandemic that is still with us. Just as for info. This is not to say buy and sell for any US REIT. So, oh, sorry, my hands have moved faster than my brains, and this happens as we age. So, in the future, we could have different asset classes, but data centers as a proxy from work for home is very popular, and we've seen, I think, Mapletree Industrial Trust and Ascendus REIT buying big portfolios recently. Warehouses are also a proxy for e-commerce, and we've seen, I think, in the top 10, in the top performers over the last 10 years, we've seen the top performers actually Mapletree Logistics Trust. A lot of it was in the last couple of years when e-commerce trends became very popular. And we could have new asset classes coming to Singapore. I think student housing, much has been talked about student housing, SPH, and some market observers say it could be Singapore Property Holdings. SPH is a large student portfolio. They call it purpose-built student accommodation, about $1 billion or so, and that could be coming to market. Mapletree Investments has a US $1.3 billion portfolio of student housing. And so those things could come to market. A cold storage is another asset class that a handful of REITs have a presence in. And that there are other asset classes such as multifamily, residential property, and telco towers. So these are REITs that are not in Singapore that we could see in the future. Right. So I just want to plug our EDGE stories. We had a global, our cover story was on the global tax overhaul. we did something on future of investing in real estate with cold storage and logistics. It was an interview with PGIM. PGIM was the manager of the fund that was sold into Fraser Centrepoint Trust with retail, suburban retail REITs, which are suburban retail malls, which have done pretty well within the REIT itself. And so that's the last one. Yes, okay. So before I check the questions, do we have questions? I must ask my director. We have questions. Oh dear, okay. That means I have to stand for long. Excuse me, can I walk a little bit? All right. For the next chapter 2, okay, we're going to have chapter 2. So since we mentioned REIT models, I was going to do that all in this chapter, but it was too much. You see, my director and my producer just felt that I was all over the place with a REIT model. So do it separately. So we're going to do internally versus externally managed REITs, the fees and the capital structure, and the importance of sponsors, because I think sponsors really can make a difference between performing and overperforming. All right, so, okay. Oh my goodness, we've got some. Can you all see the questions? Oh my, okay. So, right. All right. Okay, so I can't, my voice is not very clear, I'm sorry. Is it better now? All right, okay. Okay. Right, okay. So as REITs, okay, let me come from the bottom up. Okay, we'll start with the bottom. Oh, no, bring back that one about REITs dying. Okay, dying a natural death. Okay, okay, dying a natural death. Okay. So as REITs have to distribute most of their profits to shareholders, and as most of their assets are leasehold, wouldn't the REITs die a natural death eventually? So this is REITs, their capital structure. The REITs are known to have a weak capital structure because they have to, for the tax transparency, they pay out all their income. So there will be no retained profits or retained earnings, which is core equity in a capital structure. So I can't go too much into detail because my directors are worried. I've lost them, so I hope I don't lose you. But so when REITs need to grow, so they don't die yet, they grow. When REITs need to grow, they ask you, the unit holder, for money. But when they do that, they would ensure that the distributions they give you will rise, will grow as well. So REITs don't eventually die. Leasehold, you can actually, all right, so in Singapore, in a lot of the REITs have actually gone to Australia, gone down under, gone to Europe and America to buy freehold property. But just a thing about leasehold property, you know, there were an example. I think I mentioned Ascot Residence Trust and CDL Hospitality Trust, each owned a service residence and a hotel at this Liang Court. And that was an old development and the lease was running down. So now they're going to redevelop the whole thing and they've got a fresh 99-year lease. So you can top up leases. Yeah. And I think if you talk to your industrial REIT managers, they will also tell you that they work with JTC to top up leases. Right. Okay, so, right. Okay, so let's move, now let's start from the top. Okay, given trend, hybrid. Okay, hybrid working model, office REIT, still a good investment choice post-pandemic. Well, nothing will be the same post-pandemic, but in the old days, I think, office REITs were a proxy to the economy because when the economy is doing well, employment is usually a lot lower than when the economy is suffering. Okay? And therefore, during periods of economic growth, more companies set up, so more companies need space. Tertiary industries, industries, services, like financial services, technology, and let me see, the white collar, some may even say gold collar jobs are those that these services industry bring to Singapore, and therefore we need office space for that. So in the old days, office REITs were a proxy to the economy. And I thought this morning I read that we had GDP growth of 14%. My phone is not here, but I think it was something like that. So maybe offices won't go somewhere to die. Maybe we still need them, but so I can't give strong names. Well, okay, strong names are the strong names in the market. May I say these words? Capital Land, Mapletree Investments, Capital Corp. They're all linked to, we had a review yesterday, Temasek. They're all linked to Temasek. So they're strong names. Fraser's Property has had a very good REITs, yeah. So they've got two REITs that have performed very well, which was the Fraser Centrepoint Trust, showed you where you've got all your dividends over and above the cost of the investment, and they've got Fraser's Logistics and Commercial Trust, which is also a well-managed REIT. Okay, so those are the names. I mean, there are other names. So I think I'll take two more questions. So, all right, okay, so I'll take the last one because it's an easy one to answer. Large REITs trading at 4 to 5%. If interest rates rise, will these trade at higher yields? Yes, there's a yield spread. So the way the REITs work is that, and the REITs are valued using various metrics, but one of them is the yield spread, the spread between the yield of the REIT and the risk-free rate, which at the moment, I don't know, what is the risk-free rate in Singapore? It's like 1%. So if the risk-free rate rises, then yes, the yield, the REIT price will fall, so that the REIT yield keeps that spread. That's one thing. Interest rates rise usually because some people say inflation, yes, inflation, but also because of economic growth. And when you have economic growth, your rents tend to rise as well. Yeah, so there's a bit of give and take all over here. And so yes, if in the initial stage, when your risk-free rate rises, your price of the REIT is likely to come off to maintain that yield. But as the higher economic growth feeds into the REIT's properties, then you should get back higher valuations because rents have gone up. And one more we said we'd take. That's inflation. Okay, so that's the same thing. What does inflation mean for REITs? That's the same thing. How can I find out if hedge funds are exiting a particular REIT? Okay, may I say that I wish I knew too. And on that note, thank you very, very much for your questions. Thank you for attending this, and have a great day ahead.